Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening. And please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by the one and only Neal Bawa with Grocapitus and Mission 10K. Neal is very well known across the real estate multifamily syndication space and presents across the country at different conferences and classes and boot camps. Today's Neal's going to share his insights and opinions on where multifamily real estate is going to be over the next 24 months and beyond, as well as you're going to hear about a super value add deal that Neal and Grocapitus did just outside of Chattanooga. Now let's welcome Neal Bawa. All right, Westside Investors Network podcast. We got a huge guest today, Neal Bawa with Grocapitus. Neal, thanks for joining us.
Well, thanks for having me on the show. I'm very excited to be here.
I was fanboying Neal a little bit before we started recording. I've heard him talk at the Best Ever conference, I think 3 years in a row now. It'll be 4 this upcoming year. Neal is, can I call you a genius when it comes to real estate? Are you okay with that?
I prefer mad scientist because that really is an accurate description.
And yes, Neal is the mad scientist of real estate. Very insightful, very knowledgeable, plenty of experience. How long have you been doing it now?
10 years for a technology company that I was running, and then 10 years with investor money. So 20.
Very nice. And Grocapitus, that means Grocapitus is 10 years old?
So this is my second company. I used to work with a partner and then eventually decided to do it on my own. Grocapitus is 6 years old, and then Mission 10K is about 3.5 years old. And then before that was 5 years with Financial Attunement. And then 10 years I was building campuses from scratch for my technology company because we just had a huge amount of cash coming in and we didn't want to pay taxes on it. So we would build our own campuses. So instead of being, having a landlord, we'd basically be our own landlords. And so I built 7 campuses in 10 years. It was a lot of fun, but also a lot of stress because, you had a company that was growing at 30% year over year with hundreds of employees all reporting up to me. Our CEO was sort of partly retired. And in the evenings, like at 3 o'clock, we'd finish our meetings. And then from 3 to 9, we'd be building campuses and doing architectural and design work and going out and, meeting the city because typically the city closes at 5. So it was like having this other job, which was both stressful and very exciting.
And that experience, I guess, kind of correlates with Mission 10K, right?
It does with both companies. So Grocapitus has built thousands of units of apartments. Mission 10K builds only townhomes. So Mission 10K is a very specific mission to build 10,000 rental townhomes. So it does not build apartments. Grocapitus currently actually is in a sweet spot right now where we have 184 unit close to the end of lease up in Provo. We have a 240 unit halfway through lease up and a 320 unit going into lease up. So we're in all phases of lease up right now. We've been doing very heavy construction in the past. Now we're sort of more on the lease up side for apartments. So Grocapitus buys and builds apartments. Of our 9 exits, 7 are value add, 2 are new construction.
And what do you focus on more? Do you focus on development or stuff that's already existing and going and do the value add for it?
It's 2 different companies. There's different teams. So we have an acquisition team and we have a development team. They don't really overlap with each other. So think of it as 2 separate companies. So I can say that me and my partner are the only people that are on both sides. But other than that, they function as independent companies. Development is more challenging, especially in the last 2 years. But on the value add side, we've seen a decline in value. I mean, obviously, properties are 25 to 30% cheaper than they were at the peak in 2022. And so one has to create a lot of value, and we are working, like, for example, I have a property in Texas, in Killeen, which is north of Austin, where we've applied for what is known as PFC, where once we qualify, our property taxes will go down about $50,000 a year. And that $50,000 a year basically creates $1 million more in NOI value and helps us with our refinance, because the property, as you can imagine, is quite challenged at this point today, because we bought it in 2022.
And you said, so 7 of the 9 exits you said were value add. Of the 2, are those ones that that you started way back in the day? Are you holding those for 7-10 years, or how long are you holding these ones that you're developing?
It's a mix. So one of them, we actually started building it 2 months after COVID started, and we sold it in late 22, early 23. So it was a quick development, quick exit. The other one, yeah, it took a while. It took a while to do, and so it's a pre-COVID property that we exited last year or year before.
And the ones that you
It's been a mix.
The ones that you were talking about that are in that lease up or pre-lease up phase, how long have you had those ones on your books?
Some were 2019, some were 2020, some were 2021. So those are the sort of the 3 years where we did a lot of, let's do new projects, bring in equity. There was one project had 27 million in equity, one had 17, and another one I think was 12. So different project sizes. So obviously that was very easy to raise equity back then. And so we did a lot of these projects. Now we're like, oh, let's slow down. Let's just focus on getting these projects completed and getting them leased up. So we're very much in implementation mode right now, optimization mode, where we're basically optimizing our properties. There's a lot more asset management meetings, a lot more, delinquency meetings. There's a lot more meetings about, what are we going to do to bring up NOI than there were in the past.
And with these, I guess, with the challenges that some of the interest rate increases have caused, I think it was in 2023, the kind of mantra for Best Ever Conference was survive to 25, which it sounds like, optimization, asset management is the focus, which, falls in line with that. Where do you see the market and Grocapitus and Mission 10K going from, the beginning of 2024 through 2025 now, with rates starting to come down a little bit?
So I think we're still in that optimization mode. I think survive to 2025 works. I think I've added a piece, and you'll thrive in 2026, right? So 2026 is turning out to be, for a variety of years, a phenomenal year for multifamily. I think it will be one of the best years we've had, not as good as 2022 because that was a little crazy and bubblish. But I think that we will see rates, 5-year fixed rates under 4% sometime in 2026, not maybe throughout the year, but we'll see under 4. Just for reference, today, if I wanted to get a 5-year Fannie Mae or Freddie Mac locked loan, right, that's fixed rate, I'm right around 5.2%. So we'll see 100 basis point reduction in 2025. We'll see another 50 basis point this year. So that's 150 basis points. So if I take that 5.2, apply the 150, we could be as little as 3.7, but the math doesn't exactly work that way. So I think it's possible that at some point in 2026, we could see 3.99% for a 5-year fixed loan. And if that happens, the industry will do really well. What I'm more excited about is not the lowering interest rates. What I'm much more excited about is what will happen with rents in 2026. So in 2024, we've had the largest delivery of new apartment units since 1972. 700,000 units have been delivered this year. The market has absorbed almost all of them, to be honest. There's been slight negative absorption, but overall absorption has been phenomenal. A lot of it is because of new immigrants coming into southern markets. And so the absorption rates have been incredible, but still we haven't managed to absorb 700 units without some discounts and some reduction in occupancy. So we've seen occupancy fall by roughly about 1% this year, from above 95 to below 95%. And the thing that's very exciting is a lot of times, I make predictions, but they're really guesses, right? You look at the data and you make what you think is the appropriate guess. But there are certain areas where it's fair to say that I'm not really guessing. I really know. And one of the areas that I feel the strongest about when I make a guess is about what would be the supply for any what would be the supply of apartments 2 years in the future? Now you might say, how is your crystal ball so good? And the answer is, in the United States, it takes 2 years to build apartments. While it's possible that somebody can build one in 18 months, it's also possible that some projects will get delayed and be built in 30 months. So that 24-month sweet spot means that if I want to make a prediction of how many apartment units will deliver in the second half of 2026, 2 years from now, all I have to do is look at permits that are being pulled today. Permits are expensive. So when a developer goes out and pulls permits today and pays $300,000, $500,000, $1 million for permits, they only do that when the construction loan is signed, because they wouldn't pull the permits unless their construction loan signed. So if the construction loan signed, you're going to be in construction within 30 days, right? Because what's the point? You're now paying for equity, you're paying for debt. So if they're starting today, I know that they're going to complete 24 months from now. And so when I'm looking at the total number of permits that is being pulled in 2024 on an annualized basis, that number is somewhere around 238,000 annualized. Our demand is 450,000 units a year, right? Mm-hmm. This year, demand was much higher because of the immigration boost that we got from the southern border. So demand was more like 550, 600,000, and we delivered 700,000 units, which is why occupancy came down. We saw that rent growth this year was, 1%, 1.5%, somewhere in that range. So it wasn't very good. Next year, that number, that 700,000 delivery shrinks and goes down to maybe 450, 500,000. And and that's our delivery, that's our supply. Our demand is right around that 500,000. So next year looks like a good equilibrium year. But 2026 looks like a year where we will only deliver 248,000 units in a year where there's 450, 500K units of supply needed, right? For an equilibrium. So now you have the reverse problem that we have this year, where there's too little supply and too much demand. And so we could see rent growth in the United States in 2026 as a nation be over 5%. And individual markets could easily be 6, 7, 8, 9, 10, 11%. That's what I'm most excited about. So I tell people, now's a great time to buy, and you need to target to sell it at the end of 2026. So, get a bridge loan. If you're getting a fixed loan, that's fine, as long as you go with a lender that will give you a supplemental loan, because at the end of 2026, you should be able to get a supplemental loan and cash out your investors. If you do that, that's almost as good as selling the property. Not quite. I'd prefer to sell it, but almost as good. So that's sort of my view of where we are for the next two years. One of the key things is I hear a lot of people coming on these shows, and they don't fully understand that the 800-pound gorilla is supply. There's a lot of conversations about asset management, and I think that's really great. There's a lot of conversations about, cap rates, but the 800-pound gorilla is supply. And supply is the one thing where you can be sure about the future, because permits today means supply 2 years from now, right?
Right.
And there's not enough supply in 2026. So I'm very excited about being in that market. Pricing power should start to return next year, because in the second half of next year, in most markets in the US, and when I say most markets, I mean sort of the hotter markets, the Phoenix, Dallas, Houston, Austin, San Antonio, Nashville, and the Florida markets. By the second half of next year, supply will be slightly lower than demand, so pricing power will return. Right now, the multifamily industry in these southern markets doesn't have pricing power. Why? Because there's a lot of incoming supply coming in, and that supply is 1 month off, 2 months off. And so it gives the people that have Class B and Class C very little pricing power to raise their rents. So rents are, mostly flat, with the exception of the Midwest, which is doing really well, in the Northeast, because the Midwest and the Northeast don't have much supply coming in. Most of the supply is West and Southwest and Southeast. So the Southwest is really suffering, and on average, I'd say if I look at the top 10 Southwest markets, rent growth for the last year has been 0.
Right. Well, and I've had some conversations recently with other professionals in the industry, and they've talked about Arizona, Texas, maybe having negative rent decreases over the last 12 months, where Florida maybe hasn't seen that quite yet.
Not quite, but I think Florida is a trailing market. So we are now seeing rents fall in Florida. So Florida just sort of avoided it for a while. And there's a variety of reasons. Miami was doing well. So as a state, one can say that Florida rents are not falling yet, but though I think in the last quarter they've started to fall. So the same story that we've seen in Texas and Arizona is being repeated there. Keep in mind that Arizona as a state has not lost, it's not negative rent growth, but Phoenix is negative rent growth, where, Tucson's okay, maybe just slight negative rent growth. The other smaller markets are actually doing okay. So it's when you sort of roll it up to a state level, sometimes you miss the fact that different markets are actually reacting differently. But Phoenix is negative rent growth. Phoenix, Austin are significant negative rent growth. San Antonio, and we've seen a little bit of negative rent growth in the last quarter in Dallas, a little bit in Nashville, and a little bit in Tampa. So overall, it's not a lot of negative rent growth. The US still had roughly 1.5% rent growth in the last 12 months. The next 12 months, I'm anticipating more like 2.5, perhaps 3. And then we get a bonanza year in 2026.
Right. So I mean, based on what you were just talking about with number of units that are going to be delivered, it sounds like this interest rate conversation that everyone's having, that, everyone normally talks about, you can't make a deal pencil right now. But the more important piece that people should be talking about related to this huge spike in interest rates was what it did to development.
Yep. I think that's the story, right? That's the story. The catch is it's a 2-year lag, right? So this development is really hitting our rents hard right now. It's hitting our cap rates really hard because there's Class A properties that you can buy at 5.5 cap. So it's really hitting us hard now, but we get the benefit of it 24 months from now, right? When development does the opposite, it becomes a beneficiary to value add, as opposed to right now being the biggest, the evil Sauron that's affecting, the market.
Yeah, and you talked about a 150 point or basis point reduction in interest rates, give or take. And is that strictly based on what the Fed is saying that they project is going to be the interest rate?
Yep, the Fed is currently projecting that in addition to the 50 basis point rate cut that we've already gotten, they are projecting 150 basis points by the end of next year. I think they're right on track. So, I mean, so far, I have to say this, I can't say anything negative about the Fed, except for the fact that they were late to this party, right? So they should have started cutting rates or raising rates about 6 months before they did. So their mistake, and I have to say, unlike our politicians who never take any responsibility, the Fed has repeatedly taken responsibility for its mistakes and said, we were late, we thought it was transitory, we misread the marketplace. Now we want to make sure that we get ahead of it. Well, right now the Fed's ahead. At this point, the Fed, 3-month inflation is running at 1.5%. So there's no pressure on the Fed. They can even cut 50 basis points in November if they want to. They probably won't, because the Fed really likes to say, and they opened with a 50 basis point surprise, a really good surprise. And now they're going to go 25, 25, 50. The Fed basically says, we look at the market every month. You look at what we see. It might be a 50 basis point cut, a 25 basis point cut, or 0. We might just hold for a meeting and say, okay, we'll just let it go to the next meeting. So they're very, very data driven, and I really like that. And the other thing is that, as far as I know, neither Donald Trump nor Joe Biden have been able to influence the Fed, which is great, because both of these guys are boneheads when it comes to actually understanding monetary and fiscal policy. The Fed actually knows what they're talking about and should be left alone. And so I like that. And I think the Fed's right on track, 150 basis points by the end of 2025.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. I don't know how much you pay attention to, I'm sure you pay attention to past data, but I saw something online that the last time the Fed cut rates by 50 basis points, a recession followed about 12 to 18 months after that. Do you
It's
have any
very
opinion
likely.
on that?
I do, and I think that the answer is yes. So 7 or 8 times out of 10, when a Fed cuts 50 basis points, you will have a recession, but it's not guaranteed. Also, it's clear that the Federal Reserve over time has been getting better at slowing the economy just enough. Keep in mind, their job is very, very difficult. What is the job? What is the Fed doing? The Fed's job is to bring the economy to a near halt without tipping it into a recession, right? Near halt, right? So in an ideal scenario, the economy basically slows to a GDP of roughly 1%, and then basically they pick it up again by doing rate cuts. That's extremely difficult to do because because you're actually trying to predict what will happen in the next 6 months, right? The Fed obviously can look at it can't look at past data because it has to make decisions based on what happened in the last 30 to 60 days and extrapolate that 6 months out. So yeah, there's a pretty high chance of that it could happen at this point in time. They have an advantage though. One of the things is we can say, well, one of the things that I like to say, and you've heard it in my YouTube videos, is the Federal Reserve, out of the 9 rate cutting cycles that they've been part of since World War II, 8 of those went into recession. And the 9th was so close that it wasn't called a technical recession. It wasn't called a technical recession, but really you could have called it a recession because the economy basically fell to zero, but just didn't dip long enough below zero for it to be called a recession. So basically 9 times out of time, the Fed put us in a recession, which is an acceptable compromise for them as long as they kill inflation, right? But none of those 9 times was the Fed did the Fed have the benefit that it has right now, where unemployment is at 4.2% and they're already cutting. They're already cutting, right? So inflation's down to 2.5% or a little bit less on a 3-month basis. It's actually down to 1.5%. And so they're down, but they've only affected employment to the 4.2% level, where if you look at the last 9 times, by this time, unemployment was already at 5%, 6%, or even 7%. And that's how much work they had to put in to get the inflation down to this level. So this time they definitely have an extraordinary advantage. I don't know if that means we avoid a recession or not, but it's very important to acknowledge that the Fed has done a much better job than they did in previous cycles. And maybe there's external factors helping them. One of the big factors that's helping the Fed right now is this extraordinary infusion of people from the southern border. While I'm not at all a fan of what is happening with immigration, not at all a fan, obviously the data scientist side of me, the logical side of me says, when you inject 6.5 million people into your economy, you will get a boost. It may not be permanent, but what we needed was a temporary boost at the right time, and we got it at the right time. And it basically kept the economy humming, which kept the unemployment rate low. In the future, obviously, there's negative consequences, but by that time, the inflation rate, settles, and we may not get a recession this time. So there's an advantage there. Again, I am not a fan of what's happening with immigration, but the mathematical impact on unemployment is the opposite of what politicians like to say. Mass immigration doesn't reduce employment; it increases it, and that's anybody who is not a politically biased person will tell you.
Right. Well, we've talked about the economy. We talked about your insights and your opinions on what's going to happen here in the next couple of years. Quickly, I want to talk about a deal in Chattanooga, I believe.
Sure. Yeah.
You said you just sold that one. How long ago?
Well, actually sold a couple of years ago, but I thought I would highlight it because it's so unique and we talk about value add, and this deal is what we call a super value add. So it's a super value add deal. And so it's a 151 unit deal. It's called Park Canyon. It's in a suburb of Chattanooga. Chattanooga is about 500,000 people, and this suburb is about 37,000 people. It's called Dalton. Dalton is the carpet and laminate capital of America. And so they have a lot of factories there. So we bought this property, and we bought the property. It was very lush. It's on the side of a hill, very rolling hills, and it was built in the 80s. And I was roaming around at the property, and I realized there's a lot of trees, and there's also this massive tennis court, and next to the tennis court, there's this area where clearly something used to be there because there's no trees there. It's just like there's dirt. And so I go there and I sort of use my boot to dig around, and I realize that as soon as I dig down 3 or 4 inches, there's concrete. So I'm like, what is this? What is this? So I go back, I talked to the property manager. She'd been there for 20 years. She said, yeah, about 10 years ago, there were 20 units. There was a building there and it burned down. And we just decided to keep the insurance money. And we had this guy come in with a bulldozer and he just bulldozed it. So you have a full foundation there. We're like, oh, this is really interesting. We had no idea. I mean, right? Because the trees were sort of covering the top of that area. Like that, this is super interesting. So we have we call our lender, friendly lender, and we say, hey, there's this 20 units, so we'd like to build it. And they're like, no. I own this property. I ain't letting you get another lender in here. So we're like, oh, that sucks. So we go to the city and we say, hey, is there enough parking for this? And so of course there's enough parking because you already had 20 units there. And we're like, yeah, but we don't want to build 20. We want to build more. So we haggle with the city for a few weeks, and eventually the city says, fine, we're looking at all the parking, requirements. You can build 29 units. So we're like, okay, but we don't want to reuse we want to reuse the foundation. I said, like, well, if you reuse the foundation, there's a catch. Because you want to build 10 more units, now you'll have to add an extra floor. And if you add the extra floor, you have to add an elevator. And we're like, no, elevators are really expensive. All that concrete. No, we don't want to do that. So we're like thinking about this saying, if it's 20 units, it doesn't really work. If it's 20, 30 units, then we have this elevator issue and we don't want to, have the elevator. So we come up with a solution that the city accepts, and this is a very unique solution. So imagine a property that is sloped, okay? So this property is sloped and we're building by the side of the property. So what we did was, on one side, the property, on the side that the stairs are, the property is actually, there's it's 10 units, 10 units, and 10 units. It's 30 units, right? On the other side, because there's a slope, it's only 2 floors. And so we go back to the property, to the city, and say, well, if you think about it, you can either count the stairs on this side or stairs on that side. And this side, the stairs are only 2 floors, so we don't need an elevator, right? And then they're like, oh, we see what you're doing, you sneaky bastards. So they're like, okay, we'll come, we'll do a site visit. They come and do a site visit, and everyone's sort of laughing about it. Eventually, the city says, that's fine. We'll just count it on the right side. So now you have 2 floors, so you don't need an elevator. So now we're like, okay, great, we can build 29 units, but where's the equity going to come from? Because the bank told us you can't get another loan for this because it's inside of the bank's property, right? The property is really owned by the bank. And the bank's like, we won't do it. So we go back to our investors and we say, look, we're looking at this. The math is really compelling. We got this quote for $2.9 million to build 29 units, 100,000 a unit. And there's no way these units are worth less than 150, 160,000 because it's a nice property. It has a lake and, fountains and greenery, and it's fully amenitized. It's pretty. It's nice looking. And we had the highest rents in the submarket. Nobody else had rents anywhere close to us. So we're like, and if we can get those rents for 8-foot ceilings, we can definitely get better rents for 9-foot ceilings, granite countertops. But we're only building these at 100,000 a door. So we go back to our investors and we say, our bank is refusing to give us a loan. We would like you guys to give us $2.9 million in equity to build it, right? From our database. And we'll put in $250 ourselves just to get us started. So we talk to the investors, we beg, borrow, steal, and eventually we ended up with $2.9 million. Now, we didn't quite get to 2.9 from the investor, so we did have some money that came in from the outside. And the whole thing basically took about 14 months. And because there was no debt, there was no lender, we showed the lender basically, okay, we have $2 million in equity. The total is $3 million. We're going to continue raising. Could you just let us start? And the bank's like, yeah, go ahead. You're making my property more profitable and bigger. Yeah. So without increasing my loan, so why do I care? Go ahead. They made us like get builder's insurance and things like that. And so we go build this, and it's beautiful, right? So 29 beautiful units, about 1,000 square foot, mostly 3 bedrooms, some 2 bedrooms as well. And I think we leased up the 29 units in about 3 or 4 months because there was already a wait list. And a lot of people are like, what is this 29 units? What is the big deal here, right? What is the big deal? Okay, 29 units doesn't sound like a lot. How much could it possibly affect the property's value? Well, let me do the math for you, right? Keep in mind that the expense ratio at the property didn't change. We had the same employees for 151 units versus 180, right? The property taxes didn't change because the property already had 20 units. So it changed by a tiny little bit for the extra 9 units. We didn't build any parking. Property already had plenty of parking. We just built the vertical. And we didn't have any cost for the foundation because we already reused an existing foundation. No amenities either because the property was already amenitized, right? So can you imagine when you have 29 units at $1,100 each, your rents are going to go up by about $33,000 a month. But your expenses are only going up by about $5,000 a month because you're paying a little more in property taxes and a little more in property management fees. But everything else is already counted, right? So you have a $28,000 growth in your net operating income on a monthly basis. Multiply by 12. And you're looking at a $330,000 growth in NOI, net operating income. It was more like 300, so we'll just use that number. $300,000. When you sell a property for 5 cap, 300,000 multiplied by 20. 5 cap basically means you take 100, divide by 5, that becomes 20. So you get 20x for every additional dollar of NOI, and we had created 300,000 additional dollars. 300,000 multiplied by 20, $6 million of profit. Additional on top of what the property was going to make anyway, right? So we had to this is a disgusting IRR. I don't remember what it was, right? Was it just a ridiculous IRR because we'd created $6 million of new value, and the value add, plan that we had the property worked anyway. It was fine. We added value, raised rents by 150 on existing units, and when we sold it to juice it a little bit, we actually there was this one other tennis court where you could build another, 26 units. So we sold it with the plans for those 26 units. Now, as I know, the new owner wasn't able to build it because the market changed, but we got premium value. We had 23 offers and we still had 6 offers in best and final because the buyers were like, if these people can do it, we can do it. What they don't understand is we have in-house development team, and you should never really try to do development without having development staff. But they didn't know that, right? And so somebody says, oh, wow, I can buy this 180 unit property and make it a 210 unit property. Well, good luck to you for that. But we got out.
So, would you say that this deal is one of the, I want to call it lucky, but the fact that you were walking around and happened to find concrete, it's almost like you struck gold with your boot when you were doing that, right?
Yeah, I think that, again, we created our own luck. And we came up with lots and lots of obstacles. I haven't told you the whole story. I mean, the city basically made us drive, pull in a 170-yard sewer line because they said, you're building new additional units, the sewer line doesn't support it. So we had to get around that. It cost us an extra $50,000, $60,000. But when you're making $6 million, you can pay the extra $60,000. And I had to put that money up at the end myself because I didn't want to go back to my investors again. So there were challenges. I think the key is, a lot of times you find opportunity, but you have to be able to follow through and solve challenges. Like if the city had forced us to make the elevator, it would have made the building wider. We'd have to shore up the foundation. Elevators cost $150,000, and construction goes on much longer. We may not have even done it. So you're constantly trying to look for solutions to every problem, right? And that's really the value that we created there, not the fact that we found that there were additional units to be built. The truth is, many buildings built in the United States in the 70s and 80s, land was so cheap in the United States back in the 70s and 80s that there were many, many buildings in the US where you have the capability of building more, meaning they're zoned for a higher, units per acre than the building currently has. And in the 70s and 80s, we were also building more parking than we are building today. Today, the parking ratios are lower. You can get away with a lot less parking. So those properties had extra parking. So when you build additional units, you don't need that. But people have to, that's not enough. You have to follow up. You have to do the work. You have to establish a team and work with a builder to get it done. So it's a huge amount of work. I mean, it was probably not even worth the extra work for us, for the GPs, because we took on a massive amount of extra work. But it was just fun to do. It was interesting. It was new. And so we really enjoyed it.
And I'm sure your investors were glad that you guys decided to do that.
Yeah, it was again, it was nice that we got more than 2 of the $2.9 million out from our existing investors. They believed in what we were doing and were willing to put more money in. Nobody was forcing them to put money in.
Well, and you said that the development took 14 months. It took 3 or 4 months to get it leased out. How long did you guys have it before you started adding the additional 29 units?
A little over a year. I think the first year was obviously our value add program. And so we were focused on that. And the second year is when we started looking at this. Maybe towards the end of the second year, because it took us about 18 months to implement our value add program. And then we were like, okay, so we're done. Is there anything else we can do?
And the total hold time was what, 4 years?
A little over 4 years, yeah.
That's not a bad return in 4 years then.
Not a bad return at all. So
Yeah.
I think that those kinds of, pivots really help. Obviously, all of us know how to do the typical value add, but sometimes you get lucky and do super value add, right? We went on to do super value add again at a property in Memphis and had an even higher return. But in that case, we did not. It was a self-storage property, and the super value that we added was we built more RV parking spots, and to pay for the RV parking spots, we put solar on top, which is in Tennessee, you get a huge kickback from the government to put solar. And so we had EV charging spots, and we were charging 40 cents per kilowatt hour, and we were generating at 6 cents. So generating at 6, selling at 40.
Also not a bad return.
It worked out well for us. And that one we actually sold in only 3 years, a little over 3 years, because building RV parking spots takes a lot less time than building an entire building.
And I guess last question before we wrap this up, you mentioned storage. I know your I guess primary focus is multifamily or residential. And self-storage has been a big topic of conversation over the last 5-7 years. Do you see Grocapitus getting more into self-storage, or are you going to keep it at a minimum?
No, I think we missed the boat on that. We obviously did this one property. It was a pretty large self-storage property. But I think that we could have gotten into self-storage 5 or 6 years ago, but we were busy with townhomes and other things. So I think we've missed the boat at this point in time. Self-storage cap rates have compressed. Now, of course, they've decompressed in the last 12 months, like every other asset class, but they haven't decompressed as much as multifamily has. Multifamily cap rates have changed more than self-storage has. So I just think that there's less money in self-storage today than there was in the past. The good operators are in there, they're making offers, they're doing their job. It's just the mathematics is not as compelling for self-storage as it was about 5 years ago.
And based on what we talked about earlier, 2026, multifamily should see an increase again. So it sounds like multifamily is where you want to be right now.
Absolutely. And I'm making the bet that I think that Kamala Harris will tweak out a win. I don't think that they get to some absurd number of seats in the House or in the Senate. But I think that as long as we have a Republican president, we should get a healthy amount of immigration. And that definitely helps us from a perspective of rent growth.
Absolutely. Well, Neal,
I don't think it'll be crazy like what they did in 2022 or 2023. I get the feeling that Democrats figured out, oops, we made a huge mistake. Let's not ever do something as stupid as this again. But I think we'll get a healthy rate of immigration.
And I would tend to agree with you. We can talk politics when we're at Best Ever Conference 2025.
Sounds good.
Neal, where can people hear more from you? I know you got a YouTube channel. Where can they find you online?
The best thing to do is to either Google my name. I'm the only Neal Bawa on the World Wide Web. And so everything good and bad is about me. Or just type in Multifamily University into Google, click on that link. We publish 10 webinars a year. About 20,000 people sign up for those webinars. I just did one for Airbnb. So short-term rentals is something that I'm interested in. And we had 1,400 people sign up for that webinar. So these are free webinars. We do them on all kinds of different things. My next webinar is the impact of artificial intelligence on industrial real estate. And that is at the end of October, beginning of November. So there are all kinds of webinars on things that I'm interested in, impact of climate change on real estate. So I do research for about 30 days. My research assistant, ChatGPT, is heavily involved. And then we do beautiful decks and we present them 10 times a year. Obviously, as you can imagine, 3 or 4 of the presentations every year are about multifamily or single family, but others are about other asset classes in real estate. So that's how we scratch our research itch, and anyone can check those out at Multifamily University. It's free. It's always free. We don't have an educational program. It's meant to be given away forever.
Awesome. Well, thank you so much for joining us today, Neal. I appreciate you sharing all your vast knowledge and expertise with us.
Thanks for having me.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.